Ever feel like trying to make sense of the financial news is like decoding an alien language while riding a roller coaster?
Right. All those numbers, the jargon just swirling
Yes,
around.
exactly. That's where we come in. This is the deep dive where we take all that complexity and, well, try to extract the real nuggets of insight, the stuff that actually matters specifically for you.
And today, we're tackling a big one.
Oh,
The first quarter 2025 earnings results for Goldman Sachs, a major player, obviously.
absolutely.
We've waded through their official report, the investor presentation, looked at a bunch of news analyses, and even the transcript of their earnings call. Our mission basically is to cut through that jargon and figure out what these results really tell us about the broader financial picture.
Okay, sounds good. So in this deep dive, we're going to unpack Goldman's overall financial health first.
Yep.
Then we'll zoom in on how each of their key divisions performed. That's global banking and markets, asset and wealth management, and platform solutions.
The main pillars.
Right. And we'll also explore, the factors that shaped these results and what Goldman's leadership is signaling about what's coming next.
The outlook, yeah.
Think of this as your personal guide to understanding a really significant financial event. Okay, let's get into it. What was the sort of headline news for Goldman Sachs in Q1 2025?
Well, the top-line numbers definitely paint a picture of strength. Net revenues for the quarter hit $15.06 billion.
Okay.
That's a solid 6% increase compared to the same time last year.
6% year over year, pretty good.
And then you look at the profit, the net earnings for their common shareholders, that reached $4.58 billion,
Wow.
which is a significant 17% jump year over year.
17% on the bottom line, that's substantial.
It is, and maybe the figure that really caught everyone's attention was their earnings per share, EPS. That landed at $14.12.
14.12.
And it's not just a big 22% increase from last year, but also, as lots of news outlets pointed out, it beat what analysts were predicting.
So they didn't just meet expectations, they actually surpassed them quite handily.
Exactly.
And that kind of positive surprise usually moves the needle on the stock, right? I think I saw their share price got a bit of a lift.
Correct. Yeah, the market generally reacted positively. Stock price went up. And beyond just the profit figures, there are also some important takeaways for shareholders.
Like dividends.
Like dividends, yeah. Goldman declared $3 per common share, payable, I think, late June.
Okay.
And they also returned a pretty significant chunk of capital to shareholders in Q1, $5.34 billion in total.
5.34 billion. That's a considerable sum. So that wasn't just dividends. They were buying back their own stock, too.
Exactly. A big slice of that $5.34 billion, $4.36 billion actually, came from repurchasing 7.1 million shares of their own stock.
Right. And the thinking there is usually management feels the stocks may be undervalued, helps boost EPS, too.
That's generally the rationale, yes. Fewer shares outstanding can lift EPS. And speaking of performance metrics, if we look at how efficiently they're generating profit, their annualized return on equity, ROE.
How well they use shareholder money.
Precisely. It was a healthy 16.9%. And their ROTE, that's return on tangible common shareholders' equity, stripping out intangibles, was even higher at 18.0%.
18%. So like the interest rate they're earning on the owner's actual tangible capital, that sounds pretty strong.
It is definitely numbers that get investors interested.
Okay, so those metrics are solid. And it sounds like the underlying financial position, the sort of foundation of the company, also improved.
It did, yeah. Their book value per share, what's theoretically left for each share if they liquidated everything, increased by 2.2% during the quarter, reached $344.20.
So a stronger base. Okay, overall, a strong start to 2025 for them. Now let's dig into the different parts of the business. First up, global banking and markets. That sounds like, the core engine room.
It certainly is a huge part, yeah. And it played a crucial role in that strong overall performance. It generated $10.71 billion in net revenues.
Okay.
Which is a solid 10% increase year over year.
10% up. And what drove that?
Well, what's particularly interesting here is that this growth was largely fueled by a record-breaking performance in their equities division.
Record performance in equities. Wow, that kind of stands out, especially when you hear about general market uncertainty. What specifically pushed that so high?
Well, within equities, both their intermediation business that's facilitating trades, derivatives, things like that,
right,
and their financing activities, like portfolio financing for clients, saw really significant increases.
Okay.
In fact, the report actually pointed out this was the best quarter for their equities division since way back in 2009.
2009. That's quite something. So does that mean market volatility actually helped them here?
It seems like it. Yeah, the increased volatility we have seen seem to have created more opportunities for trading. For you, the listener, it kind of highlights how different market conditions can impact different parts of a big bank.
Interesting. So those market swings that can feel, a bit nerve-wracking for individuals can actually be good business for certain trading desks.
Exactly. Volatility means movement. Movement means trading. Now, while equities was booming, the picture in investment banking was a bit more mixed.
Okay, how so?
Overall, investment banking fees actually declined, down 8% year over year to $1.91 billion.
Down 8%. Why was that?
The main reason was a pretty significant drop in advisory net revenues, think M&A advice. Those were down 22% compared to what was a really strong Q1 in 2024.
22% drop in advisory. Ouch. So less M&A activity happening, or less closing anyway.
Seems that way. It likely indicates a slowdown, yeah. Economic uncertainty often makes companies kind of cautious about pulling the trigger on those big deals.
Yeah, that makes sense. We've definitely heard chatter about some hesitation on big corporate moves. What about the other parts of investment banking, like helping companies issue stocks or bonds?
Right, underwriting. Well, equity underwriting revenues were basically flat, unchanged.
Okay.
But debt underwriting revenues actually saw an increase. That was driven by more activity in things like asset-backed securities and investment-grade debt deals.
So companies still borrowing maybe more than issuing stock.
Seems like it.
Well,
And interestingly, despite that overall dip in the reported IB fees for the quarter,
right.
Goldman did mention that their backlog.
Future deals.
Exactly. Their pipeline of deals expected to close later actually increased compared to the end of 2024.
Oh, okay. So maybe a sign of a potential rebound in deal making coming down the pike.
Could be. Suggests activity might pick up later in the year.
Okay, some potential light there for investment banking. Now, you mentioned FICC earlier, fixed income, currency, and commodities. How did that part of global banking and markets do?
FICC net revenues came in at $4.40 billion. That was up, but only modestly 2% year over year.
Just 2%. Okay.
Within FICC, their financing business actually hit record net revenues. That was driven by strength in mortgages and structured lending.
Record financing within FICC. Interesting.
But the traditional trading side of FICC, what they call intermediation,
Hmm.
acting as the middleman for clients, that was slightly lower.
Okay.
Declines in credit products, interest rates, commodities, they were mostly offset by high revenues in currencies and a little bit in mortgages, but overall slightly down on the trading side.
So, a bit of a mixed bag within FICC then. Financing strong, trading a bit softer. Still positive overall for the division, though.
Right. Still slightly positive year over year for FICC as a whole.
And what about that line item, other net revenues in global banking and markets? Look like a big jump there.
That's right, yeah. $197 million compared to just $12 million a year ago. That increase primarily reflects lower net losses on their hedging activities.
Hedges. So the sort of insurance policies they use worked out better or cost less.
Essentially, yeah. Lower net losses on those hedges directly help the bottom line. Less drag from that this quarter.
Got it. Okay, so summing up global banking and markets. Strong showing overall, really propelled by that record performance in equities trading, even with investment banking fees down a bit.
That's a fair summary. Equities were the star there.
Right. Now let's switch gears. Asset and wealth management. How did that segment fare in Q1?
Asset and wealth management presented a somewhat different story. Net revenues there were $3.68 billion,
Okay,
which was actually down 3% compared to the first quarter of 2024.
down 3%. Okay, so what caused the decline there? Was it just market movements?
That was a key factor, yes. The main reason was significantly lower net revenues from both their equity investments and their debt investments.
Their own investments, not client fees.
Correct, their own balance sheet investments. On the equity side, they had lower net gains from private equity holdings and actually higher net losses in their public equity investments.
Oof, okay.
And similarly, in debt investments, they saw lower net interest income, likely due to balance sheet changes, and also net losses compared to gains last year.
So investment performance dragged that segment down a bit.
It did, but it wasn't all negative for asset and wealth management. They did see an increase in management and other fees.
The recurring fee revenue.
Exactly. And that was driven by growth in their average assets under supervision, or AUS.
And AUS, that's a really key metric for these businesses, isn't it? Managing other people's money. How did that look?
Absolutely crucial. And their AUS actually reached a record high, $3.17 trillion.
Wow, over 3 trillion.
Yep, an increase of $36 billion just during the quarter. And that growth was fueled by net inflows of $24 billion.
So new money coming in.
New money coming in, yeah. Primarily into fixed income and equity assets within their wealth management client channel. This is significant because it suggests they are still attracting client assets, which gives them a more stable base for future fee revenue, even if the investment gains fluctuate quarter to quarter.
Right, that fee base is more predictable.
Definitely. And it's also worth noting their AUS in alternative investments, think private equity, hedge funds that also increased, hitting $341 billion.
Okay, so even though the bank's own investment gains were down in Q1, the fact they're managing more money overall is a positive sign for future fee income. What about the other bits of revenue in AWM?
Well, incentive fees, those are basically performance bonuses they get. When investments do well, they were higher.
Okay.
And they also saw increased net revenues in their private banking and lending operations. That was mainly due to higher net interest income from their lending activities within that wealth space.
All right, so a mixed bag for asset and wealth management, lower returns on their own book, but growth in client assets under supervision, and some positive signs in fees and private banking.
That sums it up well. Yeah.
Now let's turn to the third segment, platform solutions. This sounds like maybe a newer area or one they're still building out. What's the story there?
Platform solutions is indeed a more recent strategic focus for Goldman. In Q1, it generated net revenues of $676 million,
76 million, okay.
which is also a slight decrease, down 3% compared to the same period last year.
Down 3% here too. What drove that?
Within this segment, their consumer platforms' net revenues, think things like Marcus, maybe were essentially unchanged, flat.
Okay.
The decline was primarily in their transaction banking and other net revenues, and that was lower mainly due to lower average deposit balances.
Ah, lower deposits. That could reflect broader economic shifts, maybe clients moving cash around.
Could be. Yeah, it reflects either client behavior, maybe seeking higher yields elsewhere, or just broader economic trends affecting cash levels.
Okay. So platform solutions down slightly, mainly on the transaction banking side due to deposits. Now, let's maybe zoom back out and look at some of the bigger picture factors that influence these overall results and what Goldman's saying about the future. One thing that jumped out reading the report was the big increase in net interest income.
That's a really critical point, yeah. Net interest income, NII, reached $2.90 billion,
2.9 billion.
which is a dramatic increase from just $1.37 billion a year ago.
Wow, more than double. That's largely the higher interest rate environment.
I know, certainly. Yeah, that surge reflects the higher rates boosting what they earn on their lending activities net of what they pay out.
Makes sense. On the flip side, what about credit losses? Money set aside for potential defaults.
Their provision for credit losses actually decreased. It came down to $287 million for the quarter. They noted this primarily related to net provisions needed for their credit card portfolio.
A decrease in provisions. Could that suggest they're feeling relatively confident about borrowers' ability to repay, at least for now?
It could suggest that, or perhaps just reflects the specific performance trends within certain loan books, like credit cards. It's definitely lower than it has been sometimes.
Okay, and what about the costs? Running a giant global bank isn't cheap. How are their operating expenses?
Right. Operating expenses totaled $9.13 billion. That was a 5% increase year over year.
Up 5%. What drove the increase?
Mostly higher transaction-based expenses, which kind of makes sense if trading activity was up and also increased compensation. Better performance often means higher bonuses, etc.
Yeah, sure, pay for performance.
Exactly. But this was partly offset by lower CIE expenses that can include things like impairments, and also a decrease in that FDIC special assessment fee compared to last year.
Ah, that bank rescue fund fee.
Right. And interestingly, their effective income tax rate was pretty low, 16.1%, down from 2024.
16% tax rate. That seems low.
It is relatively low. They attributed it mainly to tax benefits related to employee share-based awards, stock compensation, essentially. So that lower tax rate also helped boost their final net earnings number.
Okay, so lower taxes played a role in that better than expected bottom line, too. Now let's talk about the outlook. What are Goldman themselves saying about what lies ahead? I think CEO David Solomon had some comments.
He did, yeah. While obviously acknowledging the strong Q1 performance, he made a point of saying they are, and I quote roughly here, entering the second quarter with a markedly different operating environment compared to earlier in the year.
Markedly different. In what way?
Well, he specifically highlighted increased risks of a recession, signaling a more, cautious outlook as they move forward. For listeners, this really underscores how dynamic things are, how quickly the economic mood can shift.
Yeah, increased recession risk. That's definitely a theme we're hearing across the financial sector. But despite that caution, did he offer any potential bright spots? I thought I saw something about M&A maybe picking up.
Yes, exactly. Despite that current client hesitancy and the sort of slowing global growth picture, CEO Solomon expressed his expectation for a significant increase in M&A activity throughout the rest of the year.
Oh, interesting. So caution now, but expecting deals to come back strong later.
That seems to be the message. It suggests that while companies might be reluctant right now, they anticipate that strategic needs, maybe consolidation pressures, will drive more activity as the year goes on. It's an interesting contrast to the immediate cautious tone.
It is, and that would obviously be good news for their investment banking division after that dip in advisory fees this quarter. What other signals did they send about the future? Buybacks are always a hot topic.
Absolutely. And building on the, what was it, $4.36 billion in buybacks they did in Q1,
Right.
their board authorized a new stock buyback program, up to a very substantial $40 billion.
20 billion. Wow, that's a huge authorization.
It's a major commitment to returning capital to shareholders, yeah. Could definitely provide support for the stock price going forward.
But they're also managing costs. I saw something about job cuts.
Yes, important counterpoint. They also flagged an expected severance charge of about $150 million coming in the second quarter, Q2. That's related to ongoing job cuts.
Okay.
So it indicates they're also actively managing their expense base, likely in response to that more uncertain outlook Solomon mentioned, balancing shareholder returns with cost discipline.
Okay, so let's try and tie this all together for you, our listener. It really looks like Goldman Sachs had a very strong first quarter overall.
Definitely strong headline numbers.
Yeah, largely driven by that really standout record performance in their equities trading business. But we saw more mixed results in other key areas, like investment banking advisory and their own asset management investments.
Right, reflecting some of those broader market uncertainties, maybe.
Seems likely. And while the CEO is sounding a note of caution about the operating environment now, citing increased recession risks,
The markedly different environment.
there's still this underlying expectation for a rebound in M&A activity later in the year, plus that massive new share buyback program.
Yeah, and what's particularly noteworthy, I think, is seeing that strong surge in trading revenue happen alongside a more sluggish environment for deal making.
Right, the two going in different directions almost.
Exactly. It really underscores how a diversified firm like Goldman can navigate these different crosscurrents. You can almost see how market volatility, maybe stemming from global tensions or trade dynamics, can fuel that trading boom, even as the same uncertainty makes clients hesitate on big M&A deals. For you listening, it just highlights that complex interplay of economic forces.
That's a really insightful point. So it kind of begs the question then, how might this markedly different operating environment, as Solomon put it, and the potential for a recession, how might that impact future financial decisions, not just for big institutions like Goldman, but also for individual investors like yourself?
Yeah, great question. Will we see this reliance on trading continue, or will deal making really pick up like they hope?
And how might those potential economic headwinds influence, say, asset management strategies or even your own investment choices?
These are definitely critical questions for you to think about as you navigate your own financial situation. And maybe to get a broader perspective, it would be useful to look at how other major banks performed in Q1 too.
See if this is a Goldman story or a wider trend.
Exactly. And maybe keep an eye on how global trade policies evolve, key economic data, just to understand that bigger context.
Makes sense. Well, this deep dive into Goldman Sachs's Q1 earnings gives, I think, a really valuable foundation for understanding what's happening right now in the financial world.
To a snapshot, yeah.
Yeah,
The situation's always evolving.
absolutely.
Duh.
It's a constantly unfolding narrative. So stay with us, and we'll continue to break down these complex topics and pull out the insights that matter most to you in our future analyses.